We thought we were building an app, but very quickly it turned into a huge data refinery that would take data not just from apps, but from connected cars, from all sorts of other devices.
Hello and welcome to Traction, the tech show exploring innovation, growth and technology success. I'm James Taylor, founder of Roaring Mouse, PR advisor to some of the world's most innovative technology companies. And I'm here at Pen 95 in Sheffield with my co-host, Peter Hopton, founder of Very PC, Isotope and Venture Community. He's also an investor, mentor and rockstar chairman to Productive Machines and Tuber. We're joined today by a very special guest, Dr. Sam Chapman, director and co-founder of the Floow. Sam, welcome to Traction. How are you doing?
I'm doing well. Pleased to be here.
How are things going?
They're going well. We've obviously been through some changes through the years, and recently it's been gone back under management ownership. So that's a recent change. So we're still going through the processing of that because it's a little bit of evolution from its prior structure to its current structure, which is usual headaches, management reorganisation, usual kind of little shifts that you need to make in order to be productive, effective in the new setting. And that's primarily a focus of the company at the moment, but that's coming towards an end and it's back towards business growth again. But we're still in that phase of tidy up, if that makes sense.
Excellent. Should we talk about the early days?
Yeah, of course.
What was the aha moment that kind of started things all off?
So the aha moment for the Floow was I was currently already running a company that didn't really have much prospects for growth. Its structure wasn't quite right. The ownership structure was spread too much. It was originally a university spin out with silent investors doing nothing. It ended up being quite awkward to take it anywhere else. Its main customers, unfortunately, for being able to shout about it, were quite secretive. There was a lot of them connected to the aerospace industry. There was a lot of defence connections. So you couldn't really ever tell anyone what you did. So finding new customers or growth, it was just kind of impossible. I found it frustrating, and I was getting bored. I needed to find another challenge. I needed to find something else. And I met my co-founder. And the first time I met him, I thought he was mad. He came up with an idea and pitched his idea to me, and I went, that's never going to work. It took me a good few months to come back and think about that again and say, it would work if. And then got into more of a conversation, and suddenly that turned into traction, and the company got formed. But the what-if moment was very much around opportunities at the time. There was a lot of changes going on in the sector we were aiming at. So the gender directive had just appeared in Europe. And with that, any product that used gender, so anything to do with financial products, insurance, pricing, anything that used it in their values, couldn't use it anymore. And they all had to throw away everything they'd done and start again. Perfect time for a startup to step in. So
we're talking specifically about the use of gender to price motor insurance.
That's what was done before. And obviously it's a bad idea, it's dated, etc. But it was a good opportunity for us to then, everyone was looking for something new. We decided actually just cut out this looking at proxies. Insurers are always looking at proxies, which brand of crisp you buy, what your credit card rating is for a product completely unrelated to those things, and use it as a differentiator. We decided to measure the risk directly. So looking at vehicles and vehicle movements themselves and using that data. Now, a lot of people had said, you can do that if you put really expensive equipment into a car. And it was done for the likes of Ferraris and Maseratis and things, but no one did it mass market. And we came forward with a proposition to say, actually, smartphone technology has come along enough. We can start to do this low cost. We can put in place new technology to start gathering data that will be really cheap to gather, that would allow new prospects to form at the same moment the market's demanding new solutions, that we suddenly stepped in and ticked so many boxes at once. It became quite easy to get through the door to at least pitch, which allowed us to start to move. But our focus, just to give that's what the company does and what it does now, is it takes data from vehicles in motion in one way or another through some kind of device, and uses that information to understand the physics and of the vehicle in motion, and then understand from that the behavior and then apparent risk, outliers, things that are behaving in ways in certain environments that are more correlated with accidents, for instance. and using that information to create new ways of quantifying the degrees of risk in terms of scoring and understanding that, such that it can be used within insurance products. And it was at the same time that we could differentiate and separate the insurer from the, oh my goodness, we're going to have to handle all this data, we're going to get so criticized. Actually, the third-party smaller company can do those things, look, without knowing who the driver is, but actually process that information in a way that separates that, keeping the consumer safe, and creates this opportunity that is win-win on every side. And that's where we stepped in and kind of created a capability to ultimately understand risk directly from how you move.
And if I'm remembering right, I think at that point there were telematic systems that existed if you were, for example, driving a truck or something else.
Yeah,
were they doing that job of assessing driving already, or were they doing something else? So what I'm trying to get to, the innovation behind the Floow, was it about replicating the telematics device with a mobile phone, or did it go beyond that?
It went beyond that. The devices before, they were measuring roughly how much miles you did, and they would look at speeds, and they may say, oh, actually you've braked 200 times, therefore you must be bad. And it wasn't with any context. If you're driving in the middle of a city, you tend to brake an awful lot more. For intersections, it's quite aggressive, confrontational environment where you have to. It doesn't mean you're any less safe than driving in a rural environment where you can operate completely unsafely without having those incidents. So the rating factors they were using weren't really correlated to risk. They weren't really relating back. So there was a lot of data science and analytics aspects around it as well. So we proposed new ways of doing things, and then took on the latest science. We brought in a couple of early scientists to share best practice, but we very quickly outstripped what was happening throughout academia and the industry within a couple of months, because there wasn't that much out there, and we went just beyond it and beyond it. That then meant we had a differentiator in terms of predictivity as well. And that is really where it becomes interesting, because as soon as you adjust predictivity a tiny amount in the insurance market, multi-billion pound market, lots and lots of customers, you make a small adjustment, a small fraction of a difference, and suddenly that's a product that's valued in the hundreds of millions to the insurer, but you're selling it for much less. It becomes a no-brain situation for them to buy, which then allows you to then get that out there. Because if it was just, we can monitor using the same things that I've done before, they weren't really making that much of a difference. They were mostly used to recover a vehicle once it was stolen. And that's what it was originally. They were mostly out there to get high-value assets, lorries or very expensive personal vehicles, and find them in the event that they've been stolen. But that changed with a lot of the things that we started to do.
And I guess what that comes to is your first customer. I know you did big deals with the likes of Direct Line.
Yeah.
Were you able to then sell it directly into a major insurer, a massive insurer, or did you have to kind of work your way towards those bigger deals?
You always have to work your way into those bigger deals, particularly those large organizations. There are so many points of sign-off, particularly for something that affects a main product, because you're sitting right at the core of what they're doing in terms of their IT. So you're trying to step in there and say, we want to take that. And they go, compliance checks, every check, ethic checks, FCA checks. We ended up counting how many approvals we needed across different departmental functions. We got to 37 in a typical insurer that we had to go through, find the individuals, and then sell them on the idea of why this was good for them. And we had to solve problems in each of these to make that possible. So there's quite a lot of barriers. At the beginning, there was just a keenness to experiment, which means we didn't need to have all of those in place. But very quickly, they became very important. We had to build more. So the first ones that adopted us, we didn't have all 37 of those solved. We had a vast number of them solved, and we could do something that was quite helpful to them, but there were still some detractors in the organizations. But at that point, that appetite for something new was enough that actually let's invite these guys in and we can try this out, such that we could then tick off the other aspects. So we did have to build those, and doing that across an insurer requires one very high-level access that goes in from CEO downwards, which as a small organisation being born in stealth in Sheffield, to go around the world and speak to the CEOs of various very large multi-billion-dollar firms was a little bit tricky to get through the door. But because of the market conditions at the time, we found a way through to it. And once we did one and got a name for it, we found it very quickly possible to step through the door of others to try and actually break down those barriers and launch new products.
I like this deeply analytical approach you've taken to sales and market fit. Identifying these 36 different tumblers in the safe to unlock it. How did you get there? Did you just kind of say, right, let's identify the 36, or did you find yourself bang on a few locked doors?
We did bang on a few doors beforehand, and one of them wouldn't even speak to me because I had long hair, which was ridiculous. But the insurance industry was a different beast in those days than it is now. It's much more relaxed. But we had a number of challenges in terms of those first early steps, but it was quite quickly seen that we had something different that people at least wanted to experiment with. They weren't going to sort of put it as their main product, but let's get a little small trial going somewhere or other. And that was the door opener that then allowed us to go, oh, but you have this problem over there. Let us tackle that as well. That allowed us to work through those other aspects in tune and working with the clients. So we worked very closely, and we still do, with all our insurers, and have a very strong kind of client management aspect that sits very closely to a particular client. And they all want something different. So we have to tailor things. We still don't have a uniform solution for everyone because everyone wants something slightly differentiated for their specific market, their specific needs, their country, their particular regulation. And all of that requires transition and change.
You started with the mobile phone technology. You were feeding that data into insurers to help them assess and price risk. But more recently, I think you looked broader at that. You're involved in wider road safety initiatives and stuff like that. At what point did you figure out that there was a broader market for the data that you were creating or obtaining?
I was always primarily focused on data, and I've done that through my career in various endeavours, is see what value you can get from the data and don't just think with your blinkered views of where it can help. Actually think it could help over there, it could help these people as well, and then speak to them and see where it might work. And sometimes that can't happen. There's regulatory barriers, contractual barriers, ethical barriers where you just say, no, I'm not going to do that. That you would say you wouldn't want to do those things. But you have to keep your eyes open, particularly as an entrepreneur. When you start building something, you think you're building in one direction. We thought we were building an app, but very quickly it turned into a huge data refinery that would take data not just from apps, but from connected cars, from all sorts of other devices. We even had Google Glasses at the beginning. We had a telematics product that ran on Google Glasses when they first came out, which had video as well as capturing the telemetry of people moving whilst they were wearing it, whilst driving it, which no one ever did. But we proved the principle of doing it first, which then, again, is the thing that opens up doors to clients. So we looked quite carefully at a lot of the technologies that were out there and looked at ways of doing things differently, which allowed us to get through many of these doors, particularly in this area of where there was strong innovation at a particular point. And it did allow us to step in and trial things with a number of organisations and then improve iteratively with them.
So tell us now about your fundraising journey. Did you raise VC, angel? What was your first kind of fundraise for scale up?
So our first raise was actually on the basis of we were starting to do business with a major UK insurer, and they were still looking at us going, this is two people in a shed. This is, a few people there scrabbling together. Surely we should get IBM to go and do this. Also, think of who's the big guy that's going to underpin this that won't fall over. How stable is this company? And so they started to have conversations around the market, and we got worried and started to think, well, actually, where do we aim here? We went to them and said, well, look, that's going to cost you a lot more. How much is the price difference? And would investing in us that would allow us to branch into other countries build the stability that you need to invest in us? And they actually looked at that and saw that that was actually a good investment for them. So our first investment came from one of our early clients. And that allowed us to have investment for growth, which within, I think, 9 months afterwards, we were probably in 5 or 6 other countries with leading insurers in the other countries. We basically stuck to the UK up until that point. Part of the deal that we accepted was for a number of years, we wouldn't look at a competitor in the UK other than them. So we locked ourselves down. But if we did, we would have created internal competition for ourselves that would have made life awkward, and we'd just spend the whole time battling against ourselves. So moving to another country was the next logical step for us anyway. So signing that deal for a few years was like, fine, our next target's not in the UK anyway, we're going to go somewhere else and try and tick off another top 10 insurer in another country. So striking that deal for us basically gave us cash. They saw it as a way of locking us down and securing us as a customer, making us stable at the same time as making us theirs. But for us, that was only for a brief period of time. By that time, we'd spread all around the world, and then we'd got business everywhere. So it worked quite well for us.
Traction is brought to you by Roaring Mouse, the PR and content agency building some of the world's most innovative technology businesses. And Venture Community, a cooperative society where entrepreneurs, experts and founders come together to build and accelerate startups.
We've seen a few, James, haven't we, where, in this era, there's not been really any decent VC in the city in this era. What we're seeing is corporate VC occurring as a result of early partnerships. Mm-hmm. We had it with Mina. Isotope arguably was the same with Schneider. The Floow. We've seen a few in this kind of era where it's changed the world with a bit of tech, and it's been a multinational or a large company outside of the area that's gone, hey, you know what, this is an amazing bit of tech, and we'll invest in that.
We did explore VC. We did look at other money, but we found, and this is the thing, you keep your options open. We found better terms in looking at clients that have a vested interest in improving that market, controlling that market. They've also got the connections that help you flourish, particularly if they've got a small piece of that as well. It becomes quite virtuous. Rather than just saying, well, you've got an investor over here, actually the value to them being involved directly in that sector is much higher than it would be to an average venture, which is just purely about the cash and will you get the returns in so many years. Here, they're prepared to adapt with the market. They're prepared to change, and they could bring you connections for it. And that, for us, has always worked very well.
So I just wanted to recap so I got the sense of journey right. You went to a major insurer.
Yep.
You were able to do an innovation project within that major insurer, prove what you had, but then in order to scale up and deliver more broadly for them, you were able to kind of effectively benefit from their financial clout and lock them in and have an invested company,
Yep.
customer for a period of time that helped finance, but you spread your risk by looking
Absolutely.
internationally.
Absolutely.
Okay.
Yeah, absolutely that. And I mean, we did consider investment in the UK, abroad, in America, in the Far East. Even at that early stage, we were looking at very much internationally at what the alternatives would be. But institutional investment for us was far better in terms of the value it would give us, with far less dilution, with much better impact for us as a business. So it was always the route that we preferred when looking at options. Even later on, we had other rounds of investment. A later one came when we were exploring the Chinese market, and we got investment from Fosun. And Fosun at the time owned a large number of insurers around the world, some of which we still work with quite closely. And they were accessing the Chinese market, which was a huge untapped potential, ridiculous numbers. And prior to this, they had an insurance system that seems insane. Everyone pays the same price, but they're allowed to fluctuate at a very tiny amount according to some factors, but no one knows what the factors are. It was a very antiquated system. They didn't have anything the West has. They couldn't understand risk. They didn't have any of the kind of the long track record of evaluating which thing was better or which thing was worse, because everyone must pay the same. Everyone must have this standard system. So when they started to unlock that, the opportunity and the market size was like the rest of the world combined, because it was brand new and unlocking at the same time. So for us, getting involved with Fosun suddenly unlocked that opportunity with not just the insurers there, they also owned insurers around the rest of the world that then had a virtuous circle effect to potentially be clients of. So we ended up in a way that supported us with access to potential new market through them, not just through the investment itself, and it unlocked access in China, which for us was a huge bonus at that time.
Did that early stage strategic investment impact the exit?
It did, yeah. All those investments have ties, of course, and some of them make perfect sense when you do them, and then later on they make slightly less sense. They make some people have certain aspects of shares that have higher rights, etc. I'm sure you're used to this, but not the whole. We've got far further than we would any other method by taking this route. It guaranteed that we had higher growth. It guaranteed that we had higher market presence, and for the first sort of 5 to 8 years, we were just growing continuously like a rocket because of this approach. And it allowed us to capture more and more of the market, which then satisfied the terms of all these investors anyway, so they were happy. So we didn't really, because it was all fine when it comes to later exits and alternative steps that we can take.
So did you end up with some high multiple liquidation preferences?
We're still not allowed to tell you everything about the various stages that have happened. I mean, what I can say is that we were due to sign a deal pre-COVID with an organisation. Then COVID hit, and our income was based on how much people travelled, which then suddenly dropped to 40% the next day. At the same time, the markets kind of crumbled, and they went, "You're just about to sign this piece of paper," and they just pulled everything. It was a bit of a nightmare for us because we've been on a ramp up for what would come next. So our finances were burned to the mere minimum on this fact that this new cash was coming, and all of a sudden that fell through. So we needed to transition. And at that point is where we looked around for alternatives whilst we restructured and replanned for a while. The market was obviously decreasing in size at that point because of that decrease of traffic. It's crept up again. We're only 3% off what it was on COVID now, and there's more penetration of devices, so it's a bigger market than it ever was. So we're in a much better place. But in terms of that period, there was quite a few challenges in terms of what does the investment landscape look like, because it was growing like this, and now it's suddenly teetering around and moving in different ways. So we had to look in other investment types. And at that moment, we looked and found a SPAC, which have not been well regarded in terms of their long-term success. They get given a huge pile of money from investors, and they basically try to gobble up companies and stick them together to try and make something that's then worth the value of all their investment income. And we joined one of these, and it was linked to a connected car kind of aspect, which unlocked data for us in the automotive market straight into the connected car parts. But with the pandemic, hitting the tech industry a few years later in terms of the economics that then happened, they got under increasing pressure for not just investment, where's your profitability and returns, but as an early stage acquisition company trying to stick things together, it wasn't ready for that. So it started to get under pressure. And we had to, as a company, adapt with that, which allowed us to make offers of opportunities that would be different. And we were the high growth part of the organisation, and other parts of it disappeared. But then in that instance, it was a very unwieldy structure that we had to find a way of merging into something else. So we were already listed on NASDAQ under this entity at that time, but we found another entity that wanted to go onto NASDAQ that would be a good aligned partner to fit with. And in the process of that transition, shares were liquidated and changed, and everyone ended up very happy. We ended up in a position whereby we were then effectively owned by this new entity with an element of controlled by management under an agreed term for a period of time.
This was Autonomo, was it?
The Autonomo was the first one. This is the second one. This is Urgently now. And Urgently reached a point whereby it itself was, once it then launched on the NASDAQ exchange, it got under pressure to do the same thing. And it was on a growth trajectory as well. It was attracted by the large amount of money in the bank account, because there was 9-digit figure bank account attached at that time in terms of the amount of money there. And they were attracted mostly by that. We just aligned it because it was strategically convenient for our business to say we fit well with this. And that actually works quite well because we were the big asset that was left in there that they had to seek alignment to for this new investment. And in that process, we looked at their structure, what their future was like, how they were planning, and what happened long term is they started to need more cash. They started to get under pressure from their shareholders to make a change. This was the perfect opportunity for us. We stepped in and said, "Management, we'll take back the company. Thank you very much." But in order to exit, various terms in the contract, they had to keep us for so many years, etc., etc. We found a very nice way out of it that basically meant we were back under management control, and we got a cash boost in the process.
This is interesting. I think you see plenty of examples where, particularly in the UK, early stage companies, you work very, very hard, potentially not earning what you would earn elsewhere, to a point where, you become potentially an acquisition opportunity, and then that becomes very, very tempting. Having been through that process, effectively being acquired, but then effectively, buying back control to the business, does that put you in a position where you can think orders of magnitude more ambition looking forward?
We do have more ambition looking forward. We are looking at new sectors entirely. I can't say which ones and what we're looking at exactly, but we are looking beyond where we were. And you said before about the traffic thing that we've been doing. Obviously, we have data that's now impacting cities in terms of work in clinical. We've got medical trials. We've got information that's utilizing data for how you move as a predictive aid for illnesses now. We're using information to replan cities in the UK, where our data is used in about a quarter of London, and 80% of UK cities are taking our data in one form or another to replan. So outside this building, the road out there and the roundabout, they took data from us. So in terms of trying to utilize this data for other courses, we're finding new revenue streams, which means we're diversifying a little bit in terms of the areas that we're looking at. But our core business still remains in this understanding risk for how things move, because it's how our data originates in the first place, which has to be our core aim. And we still stick with that.
And in looking to the future, clearly there's lots of opportunities around autonomous vehicles, which are understandably very data heavy. And, you look in the wider world, not just in insurance and automotive, but the world's becoming much more data driven. How are you gearing up for the decade ahead?
We've been involved in that since the early stage. We helped launch the world's first robo-taxi, which was Europe's first robo-taxi, which was launched in London. It was quite a number of years ago now. It operated for a bit to prove the principle, and obviously things have moved on since. But we helped launch that. We've been involved in autonomous technology, advanced vehicle technology, and reading data out of them. Using that data we help with compliance and regulatory work using that. So we're taking things from LiDAR, radar information. So it's way beyond what we do for our main business, but we're still consuming and utilizing those data. And we get involved in a lot of research projects still to widen that yet again and look in new areas. And those are really quite varied. They cover quite a lot of different sectors that people wouldn't traditionally associate us with, but whereby the data capabilities we have or the type of data that we have an influence upon other sectors and markets, whereby we can put our things together with something else and actually create new value.
So, Sheffield, let's talk about Sheffield for a minute. Yeah. I love the startup ecosystem here. I know you're often heavily involved in it and I see a number of our events and in the city. What's the most exciting thing you found in the Sheffield Shed? So
by Sheffield Shed, I think you mean another business, a growth kind of...
Well, something that's really early that you've investigated or looked at.
So my favourite comes from a while ago, but you'll start to see it on the high street now, which is a company called 1024. Which was they were based near Crooks, just in a tiny building somewhere. And all they did is they took cameras, lots and lots of cameras, and then orchestrated them in a huge sphere around an object, and basically orchestrated them to basically record everything that's inside, that they would build up this 3D knowledge. And very quickly it was used to start scanning things for Hollywood. It was used for every kind of film. So they were shipping all the famous actors out to Crooks. going into this tiny little shed in the middle of nowhere to get photographed by this machine. And it was a fantastic piece of kit, but it was fantastic because it was a new idea. It took existing technology and just repurposed it in a way. That's now turned into something that's now on the high street in Orchard Square, the Sapiens project, if you've heard of it, whereby if you walk in there now, anyone can just walk in and earn money to have their face scanned. You just walk in there and they give you 40 quid for the privilege. They're using it for gaming, they're using it for future advertising, they're using it in lots of different ways. And so they take that information and they're taking the values of all faces that they see, but they're also using AI on top of that now to create new capability that populates. When you start to think, do we always need humans for these things? Actually, they can fill the gap. They can fill the gap for virtual artists, they can fill it for computer games, they can fill it for advertising. The value of that commodity that they're building up in terms of a data bank of this information has huge value, and it's been grown in Sheffield. And I think that started from people nailing cameras together, literally nailing cameras together in a spear to say, we're going to take a picture of something in 3D, wouldn't that be cool? And that became something that I thought was a hugely interesting project. I've only chatted to them a few times over the years, but I've always thought it was fascinating.
A year is a long time in technology, so to have been around for over a decade, when you reflect on that time, how have you personally changed through that journey, but also how has, what's your observations on how Sheffield's tech ecosystem has changed over that period as well?
I'll start with the tech ecosystem growth first, because I think that's fundamentally changed over the last decade. When we first started, it was a case of trying to find an office that had an internet connection was like struggling. Or we can have one, yeah, but the speed of it was just impossible. So trying to find, limiting ourselves down to 2% of the offices that were available as places to operate from, because they just simply didn't have the facilities that supported IT companies. That has fundamentally shifted, but not just that, the number of firms, and it becomes a core part of the ecology of the region. And when we first started, we tried to get recognised that there is an IT sector in the city. And we spoke to Westminster and they went, oh, there's none there. We've got some in Manchester, we've got some other cities, but there's nothing in Sheffield. So I spent time going to London and saying, actually, I'm representing this, and there's a whole load of other people behind me. Actually, there's loads of people, and started talking about it. And we very quickly got into conversations with Department for Business and Trade, who wanted to come up and do let's do a review of everything that's in the area. And suddenly they came up with this different picture that suddenly went back into Whitehall and started affecting policy. So I think that had a fundamental change in the area. It was all behind the scenes, but actually it did change investment, it did change strategy, it did change the investment for transport, because even in Transport for the North, they recognised Sheffield as a technical centre because of some of the stuff we were saying. Actually, there is all this stuff there that led to millions of pounds of investment in terms of transport improvements across the region that came from recognition of clusters that simply was missing technology. It was not there. So I think that helped, but I'm one of many people that helped. I was not just one doing that. But we've always spent a lot of time trying to push that. And I think that the city has fundamentally changed. And I think in the last couple of years, I see a huge maturity growing that has been lacking. There's always been a case of, oh, I've got a deal, fantastic, I'll sign it. Have you checked the terms? Is that going to be good in 5-10 years' time? What's your exit going to look like? Actually, there was a lot of people growing, but growing for growth's sake, not growing for the future's sake. And some of that wasn't well formed because it wasn't well educated. We didn't have companies that were teaching that growth story that went down into other organisations, or enough of them doing that. And that I see has fundamentally shifted. And I see there's a huge appetite now in terms of funding into the region. So in terms of VC investment, for every pound that's spent in the region, it's about £7.40 or £7.60 that they end up getting back on average, as opposed to London, £4.30. There is a huge advantage for the North in the fact that there is more potential here, there is more value, it operates at lower cost, there is a huge value for growth that is now being more realised than ever. It's taken a long time, but I see this as being a pivotal moment where an awful lot is changing, and it won't just be 2 or 3 big companies. In 5-10 years' time, there'll just be a whole load of people, a whole load of different companies, and there'll just be lots of different brands. And I think the city is growing massively because of this.
And how have you changed?
How have I changed? Picking up new technologies. I think the biggest thing for me was I always took on the tasks that we didn't yet know how to do. So whether that was a technological task, particularly in the early days, but later on it was the person that needs to understand regulation in country X that we've never looked at before. Oh, why not? I'll just go in, get stuck in and try and uncover the way of doing this. Then it teaches you how to employ people that do know that. Because rather than just going there, we need to solve this problem, employing the first person that says, yes, I can do this, it gives you an appreciation. You may not be an expert in it all, but it gives you an appreciation for the areas that you're trying to get people to be employed into. So I've become much more diverse as an individual. At the beginning, I was focused on technology. Now I'm focused on far too many different things, and my attention jumps from one thing to another of wherever we have a problem or wherever we're doing something new. So our day-to-day insurance business, I don't get involved until it's a point of innovation. It just happens in the company. I get involved where there's something new to do, new research to do, or there's a challenge or something emerging. And we do have that all the time, particularly with the way the world's changing at the moment, current geopolitics. There's a lot of transition happening again, which I think the tech industry should see not as, oh my goodness, it's a hindrance, how will I trade? This is a huge opportunity. At the beginning in the Floow, we saw the change in structure and the regulation constraints coming in as the opportunity that helped fund us. There are businesses out there that are going to capitalize on these changes and look at what those opportunities are, because I think any business out there needs to take advantage of these.
Excellent. Thank you. That's all for now. From all of us here at Traction, thank you for watching. Thank you for listening. Thank you for being part of the show. If you enjoyed it, comment, share, follow us for future episodes. Until next time, goodbye.
Goodbye.
Goodbye.